It's July 4th weekend, and what's more American than trying to keep Uncle Sam's grubby hands off of your money?
It's your money, it's my money.
What money?
Hi everyone, I'm Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. In the end, it's not what you make, it's what you keep. Now, I know that's not as profound as the love you take is equal to the love you make, but it's an important concept. Making a lot of money is great. In fact, it's usually better than not making a lot of money.
I try to be contented, but it is hard.
That's a hot take, I know. But if you make a lot of money and don't keep a lot of money, well, that's not great. One of the most common questions that I get is about how to structure investments in order to save on taxes. So stick with me for the next few minutes as we dive into the fascinating world of tax efficiency. Okay, but for real, this will save you piles of cash, so keep watching.
Save us some money.
For the purpose of this exercise, I'm going to assume that you're in the 22% tax bracket or above, which is if you earn $89,451 filing jointly or $44,726 if you're single. An important concept to understand that interest is taxed at a higher rate than dividends or capital gains. If you earn interest from a bond, CD, or anything else, it is typically taxed at your ordinary income tax rate, which we're assuming is 22% or higher. Dividends and long-term capital gains are taxed at 15% if you make up to $523,050 married or $492,300 single. Above those levels, and the tax rate is 20%, but there is also a 3.8% surtax if you make $250,000 married or $125,000 single. The IRS never keeps anything simple, does it?
Oh, you almost had me. But you cannot declare offshore investment losses against future capital gains.
So, if you're married and you make $200,000, you'll pay a 15% tax rate on your dividends and income. If you make $250,000, you'll pay 18.8%. And if you make $600,000, you'll pay 23.8%. Now, it's usually best to keep investments that pay interest in your tax-deferred accounts because you'll pay a higher tax rate on that income than you would on your dividends or long-term capital gains. So let's say you're in the 22% tax bracket and 15% for capital gains and dividends. If you had an investment that paid $500 in interest and another that paid $500 in dividends, if they were both in a taxable account, you'd owe $110 tax on the interest and $75 on the dividends. So if you could only hold one of those in a tax-deferred account, you'd be better off holding the one that pays interest, where you'd owe $110. So the idea is to keep investments that have higher tax burdens in your tax-deferred accounts and the ones with lower tax burdens in your taxable accounts.
That makes a lot of sense.
Yeah.
Now, of course, if everything will fit into your tax-deferred accounts, that's even better, as long as you don't need the money before you're eligible to take it out. But tax-deferred accounts have limits as to how much you can contribute, so some investors have to make choices about which accounts to keep certain investments in. Now, one thing to keep in mind is if you're nearing the age where you'll have to withdraw funds due to your needs or the required minimum distribution, or RMD. In that case, if you're holding bonds in a tax-deferred account, you want to make sure that you have the amount you have to withdraw in cash and not tied up in a bond so that you'll have to sell. So for example, if you had $2,000 in cash and need to withdraw $2,000 in the next year, I would not recommend buying a new bond that matures in more than a year. No matter how attractive the interest rate is,
leave it alone. It is very expensive.
Keep it in cash since you'll have to withdraw it soon. Additionally, if you own a partnership like an MLP, that belongs in a taxable account. The dividends are already tax deferred. You won't pay tax on most or all of the dividends until you sell, so there's no reason to take up space in your tax deferred account with an investment that's already tax efficient. Furthermore, if you own a lot of shares of a partnership and hold it in a tax-deferred account, you could still be on the hook for taxes and even penalties, depending on how the dividend is classified. So it's just safer to hold the partnership in a taxable account.
This is valuable information.
Now, I also recommend holding most international stocks in a taxable account. Stocks from Canada and the UK are the exception, but most other countries other than Canada and UK take taxes out of the dividend before you receive them. At least Uncle Sam trusts that you'll pay taxes on the dividends.
Money, please.
The foreign governments don't trust you at all. When those taxes are taken out, the IRS issues a foreign tax credit so that you're not paying double taxes to both the foreign government and to the IRS, but that's only true if the stock is held in a taxable account. If the stock is held in a tax-deferred account, the foreign government will still take taxes out of your dividend, but the US government will not issue you a tax credit, so that money is gone forever.
So you get nothing. You lose. Good day, sir.
Enjoy celebrating the 4th of July, and while freedom isn't free, it also shouldn't cost you 1 penny more than you legally owe. Use these strategies to hang on to more of your money that can be spent on hot dogs and fireworks. For more income building and money saving ideas, check out my free e-letter, Wealthy Retirement. Just click on the link in the description. I'll see you next time. I'm Marc Lichtenfeld. Thanks for watching.